Check, please.
Welcome back to Everything Money. In this video, we're going to discuss the concept of growth stocks. Paul, as a still sort of new investor, you've been doing this for 20 years. I still have problems with the concept of growth stocks. They sound so great. They're growing, and it's not really a value investing approach. So you're going to hear Paul and Mo's thoughts on the myth that we think is behind what people try to convince you and themselves when they're mentioning growth stocks, which, oh, by the way, they're not so much growing anymore. So, Paul, can you shed some light on this process? Because people on the internet say that you are way too conservative, you don't like growth stocks, and clear it up for me, please.
I'm reading a book called Essentialism about how to operate at work. And it basically says if somebody asks you to do something, you have an idea to do something, if it's not an automatic, obvious yes, then don't do it. The same needs to be applied to investing. If it's not an automatic yes, you should not do it. The best investors of all time, all of them say you have to wait sometimes. You have to be very patient. The difference is people have a hard time. They have a thing called FOMO. We were just talking about FOMO before. I have literally zero FOMO. The FOMO I have is sitting on my couch. I'm like, man, look at my couch. It looks so comfortable. Look at those pillows just sitting there.
What about the viewers at home, though? Because I get tickled with FOMO on the daily because I just keep watching videos where everything is so wonderful.
This is why investing is difficult.
Yes.
And this is why buying an ETF, a low-cost ETF, and not thinking about it and just buying every month is the best route for 99% of people.
Mm-hmm.
But if you want to dabble in stocks, one of the things to do, it allows you, if you have 80, 90% of your money in ETF, as it goes up and up and up, you can still spend 5 or 10% of your money having fun with other stocks. I'm not saying avoid growth stocks. I'm not anti-growth stocks. Growth is one of the most important aspects of value investing. What I'm saying is you have two companies that are exactly the same. One is growing 15% a year and one's growing 5% a year. I will 1,000,000% pay more money for 15% a year growth versus 5%. If that is me not understanding growth, then I don't know what to tell you. Now, what people are saying when they say they don't understand growth is, I'm not willing to overpay for growth like you effing losers who are too stupid to understand that it's possible to overpay for growth.
Exactly, yeah.
Let me bring an example. This is our Everything Money software. We have something called the Stock Analyzer tool. Every investment is the present value of all future cash flow. We don't know the future. We can only make assumptions about the future, and the Stock Analyzer tool has become the most important part of our software and the most popular because it allows people to make those assumptions on growth and profit and tell you what you should pay today for the company. So let's pick an example. Let's pick, what's a fast-growing company? Tesla. Let's just talk about Tesla. And let's do a 10-year analysis on Tesla. Now, these are Tesla's gross. I said Tesla. These are Tesla's growth numbers for the last 1, 5, and 10 years.
Jeez.
Okay? They've grown 90% revenue for the last 10 years. A year. Not 90% total, 90% per year. What did they do last year in revenue, Seth?
Oh, boy. Yeah, off the top of my head.
Well, why don't you look it up real quick?
I'll look it up right in our software.
Yep.
Last year they did $46 billion.
So, if you believe Tesla is going to grow 90% a year for the next 10 years,
boy,
that would be it doing $28.2 trillion in revenue.
Probable?
Keep in mind, the U.S. economy does about $23 trillion a year. This would make it larger than the U.S. economy today. Okay?
So we have to pick an extreme, Paul. It's
Well, we talked about this on our trip.
Right.
Seth always criticized me, Paul, you always go to these extremes. And I finally explained it the right way. Guys, I go to the extremes because I realize the extremes are probably not right, and it allows me to focus on the middle. Okay, what's the extreme on this end? Well, Tesla doesn't grow at all. Okay, is that likely? Probably not. Mm-hmm. The other extreme is it matches the last 10 years of revenue growth and becomes a $28 trillion company in revenue.
28 trillion
It's somewhere in the middle. Okay. Now, does that mean we assume 40% revenue growth? Okay, let's assume 45% revenue growth, which is halfway between 0 and 85.
I think they're predicting somewhere near this number.
$1.9 trillion in revenue.
Jeez.
If the average car, so how do we do this? Times $1 billion. If the average car is going to be $60,000 for Tesla, that would mean they're going to sell 31.5 million cars a year.
Mm-hmm.
Currently, we manufacture in the entire world something like 50 million cars a year.
It's like 66
okay.
or 70, something in there.
So is it likely that Tesla has half the market? And even if it does, what's that worth to us today? So
But Paul, you just don't get it.
I don't get it.
You're not educated on what Tesla can do. You haven't read the reports and you haven't read what they're coming out with. You just don't know.
So when people say it to me, these are the same people who say that Googling is Tesla awesome is doing their research. This is doing the research. Say, is it probable that what I'm going to do, if you go to a high school and you go to the state and say, give me the top 10 baseball players, sign them with $30 million year contract today. That's what you're doing when you're overpaying for Tesla's growth.
Actually, with Tesla, you're going and saying, give me the number one baseball player, and I'm going to sign that one player, and I hope that one pans out. You're not even picking 10.
By the way, it's not even the number one player. It's not even the number one player because Tesla's not the number one car company in the world.
Okay, so you just pick number 10 on the list, and then you sign him to the $30 million.
Yes. Okay, so let's do these numbers here. Let's assume low growth rate of 20, middle of 30, and high of 40. Profit margin. Let's assume that they do a little bit better than the other car companies, 6, 8, and 10. Free cash flow, let's assume the exact same thing. PE. Now, here's where we're all going to argue. People are going to tell me, Paul, you got to assign a huge PE to this company because it's innovative. Guys, higher multiples go to faster growing businesses. So when you tell me I don't understand growth, you don't understand growth because the second a company becomes large, it's harder for them to grow. Therefore, you have to pay a smaller multiple for them. Mm-hmm. Right?
$1 trillion company right now.
It's a $1 trillion company already. So I'm going to assign a PE 30, 40, 50, which I think is insanely high. Mo's even laughing already.
I thought you were going to put 25 on the high
I'm going to do 30, 40, 50. And I want 12.5% return because why? I should get that for owning Tesla. Analyze. Guys, only on the highest of assumptions at 50% revenue growth, 40% revenue growth, does it even justify today's price. So 50% revenue growth. That is my point about the myth of growth. What we hear is this company has a lot of potential. And so people end up paying through the nose for it because there's a lot of potential. Just remember back in 2000. How much bigger is the internet today than 2000?
Paul, no one remembers 2000. That's the point.
That's the point, though. That's why people miss out because our financial memory is only 4 or 5 years. But you've got to go back and do the history. History doesn't repeat itself, but it rhymes. Mm-hmm. It's very, very similar. No company, Paul, the internet's so big, it's going to be the biggest thing. And they were right. And companies still went to zero. The vast, vast majority of companies went to zero. If you bought all the tech and .com companies back in 2000, you only make 3.3% a year for the next 22 years. And that 3.3%, 80% of that return was from Microsoft, Apple, and Amazon. And Amazon fell from $195 down to, $113 down to $6 per share before it finally started to trek back up. And if you're telling me you would have kept with Amazon as it fell 95%, you are absolutely delusional. You are dumber than dumb could be, and you should go take your money and flush it down the toilet because that's where your money deserves to go. I understand growth. You don't, just by saying I'm going to pay whatever for growth.
And also, if Tesla, let's say they're doing all of this and their revenue is what it is, what do you think Apple and Amazon and Microsoft are doing? Are they still double, triple, whatever they are of that?
So why do they call that? They call them growth, sort of.
They are growth. They are growth stocks. Tesla's going to grow faster than Ford and GM and all these other big car companies, but it's possible to overpay. My comment is, if it's right at 1,000 and you don't use the calculation to figure out what that return will give you, then why not 10,000 a share? Oh, Paul, it's ridiculous. Why is that more ridiculous than 1,000 a share? You didn't do the numbers. It's growing like crazy. When your only idea is it's growing, therefore I'll pay, then you don't have an understanding of why 20% is better than 5% growth. Why is 40% better than 20% growth? You're not assigning different values to that. At the end of the day, you're buying a stream of cash flow. You're buying a piece of a business. And as Charlie Munger says, if you're not buying a piece of business, then what the hell are you buying? That's it. The only thing difference is you see a ticker symbol and think price and value. It's not the same thing. So guys, understand growth. Understand that different growth rates justify different prices. That's all I'm saying. In a hype market, just like in a down market, people are overhyped on a company that has growth potential and they dismiss everything else. In a down market, nobody cares about any news. It's all bad news. It's all terrible. And that's why stocks go far below where they should be. I'm just asking you to be patient. Does that take a long time? Absolutely. Do you have to be stubbornly lacking FOMO? Absolutely. I stubbornly lack FOMO. I literally hear friends of mine saying, Paul, you just don't get it. You're right, I don't. And that's why I voted. But history has shown me that when you don't get something and you avoid it, you tend to do better than by following it without understanding. We just did a video on Micron Technologies. all these amazing investors that I adore all own it. I don't get it. I avoid it. These are guys I think are brilliant and smarter than me. And I just go, I'm not going to buy it. Why? Because I don't get it. Literally no fear whatsoever in that. Wow. So that's my whole point about it, guys. I just sit there and say, I don't get it. I'm not going to do it. That's it. I don't get it. I'm not going to do it.
Paul, here's a quote that this guy, this brokerage firm guy suggested that everyone should stop being so small-minded. He declared that Tesla is on track to top all other car companies in the next few years to become the first company with market value exceeding $1 trillion.
Do me a favor. If you've made it this far in the video because you're like, man, maybe this guy makes sense, go back and Google articles about all the top companies like Cisco.
I just duped you. This is an article from Cisco. I just replaced Cisco with Tesla. So at the time, Cisco.
Well done.
At the time, Cisco was a $500 million company.
$1 billion company.
$1 billion.
Billion.
And they were projecting to go to $1 trillion. This was 22 years ago.
And now they're at what?
A quarter, 250 million. So
250 billion.
Billion. Sorry about that.
So guys, recap.
Please do.
22 years ago, Cisco was at 500 billion. This guy said it was going to $1 trillion. 22 years ago, it is now at 250 billion. So it's fallen by more than half 22 years later.
This was the biggest company in the world, the top growth stock.
If you literally said this isn't going to work, you were looked at stupid. Sound familiar?
And sure enough, if you put any money in at all, you have half of it now.
If you made it this far in the video because you like what I'm saying, subscribe. And I never ask for subscribers, but subscribe. And the reason being, this all makes sense. It's a way of viewing the world. And this is only going to make sense to 0.5% or 1% of the people who watch this video. And I'm okay with that. I'm okay with that. But if you don't believe that an investment is the present value of all future cash flow of that business, then I don't see what you're doing in this world of investing.
Yeah, this is definitely a contrarian view. We definitely get a lot of hate for this. And
saying that's a contrarian view to me is like looking at the sky and saying it is not blue.
Yeah, and in
to me, it's so obvious.
It won't be very. It's contrarian in this market. It won't be very contrarian.
No, it'll still be contrarian in the future. They'll just blame something else. Like I remember in our group chat, they still tease me and going, "See, Paul, you're right. COVID caused the crash." I'm like, "No, it didn't. Yeah, COVID was the spark in the room filled with gasoline." Guys, if that was the case, at the end of the crash in 2020, when COVID hit, we had only 5,000 cases in the US, and that's when the market started to rebound. Now we've had tens of millions of cases, and the market's over double the size. So if it's really COVID, why did we go from 5,000? When the market fell to 2190, the S&P went to 2190 from 3390, and we only had 5,000 cases of COVID. We now have 100 million, 200 million cases of COVID, but the market's now at 4,600.
Yeah, the fear
that doesn't make any sense.
The fear was that we would have 100 million cases, and now we do, and now it's fine.
That's the point. If you honestly look at this and say COVID caused this crash, you're just as dumb as I don't get how to say that. Like, guys, if it's the fear of COVID, you're telling me if I told you at 2190 that we'd have 100 million cases of COVID, where would you told me the S&P would go? 4,600? And that's where it went. Don't tell me it's COVID. What it is it's the excuse given, just like the analogy of divorce. Your husband leaves the milk carton on the countertop, and she says, that's it, I'm done, we're getting a divorce. Was it really that caused the divorce? No, it was the years and years and years, the husband not listening to the wife saying, I'm not going to do what you asked me to do. And that's what caused the divorce. The fundamentals of the marriage were bad. The fundamentals of the market were bad 2 years ago, and they're worse today. I understand growth. I just don't overpay for it. You don't understand growth. You don't understand investing. So
in the end, and very few people who may react to this video are going to take, are going to cut out a line like this. But in the end, we're trying to offer you a lifeline. If you've been out there watching all of these people just saying how much you have to load up on all these amazing companies that hardly make any money at all, just be cautious out there. You want to limit downside risk. And this is not the word. What Paul's telling you is not his. These are not his thoughts. He's mimicking what the greatest investors,
time out.
The greatest investors in the world have been saying.
But they are my thoughts. But when you start looking at it, you're like, oh my God, we all think alike.
Yeah.
We all think. Now, granted, I've taken some from other investors, but I remember it's funny. Like I'll read. Like I always said risk was the price you pay. And everybody said no. For the first time ever, I read this weekend that Charlie Munger says that Ben Graham says that risk is the price you pay. I've never heard it from anybody. And literally people have said to me like, I don't know about that. I'm like, no, risk is the price you pay because risk is a loss of capital. The less money you pay, the less capital you're going to lose. So it's risk. That's risk. Everything, nothing in this world is, this phone at $1 is a lot less risky than this phone at $10,000. It's the exact same phone. This item is not the risk. The price you pay is the risk.
So in the end, we say all the time, we're looking for a very small percentage return above normal, 2-3%, or save yourself 2 or 3% in the loss column can result in multi-millions of dollars on the back end when you retire. And so join us if you're in love with numbers and a patient way to invest moving forward instead of YOLOing your money into growth stocks like ARKK and then having half of it a year later.
So guys, we created a software because our users were sitting there saying, how do we analyze stocks without waiting for you to make a video? There are 10,000 stocks out there. They wanted to analyze them themselves. So we made our software. We spent hundreds of thousands of dollars. You get all of this. You get everything you've seen so far, the 8 pillars tool, retirement calculator, stock analyzer, 8-pillar portfolio, exclusive video content. Every single day we post 1 to 3 videos made by us only for our users. You get all of this. You get everything on the phone app like Seth said. But most importantly, if you feel alone, you get the community of over 6,000 people who use the software every single day to talk about your investment ideas. Because you might be the only one of your friends who believes these thoughts. You can't talk to them. You go into the chat right here in the top right corner or on your mobile phone and talk every day about every investment idea you have. This is all for only $1 per day. Whatever price you pay, you are locked in forever. $1 per day gets you everything here. 30 years of financial data. This is a no-brainer, guys. Our competitors are $199 to $500 a month. $1 per day gets you this software. Go sign up now. 2 ways to sign up, everythingmoney.com or Patreon. The benefits of everythingmoney.com is you don't pay sales tax yet because we're not big enough. Sign up $1 per day.
That's our take. Final thumbs up. Join the community below. Click the link, everythingmoney.com, and we'll guide you. Thanks for watching.